All right, good morning, everybody. Welcome to Preparing Your Company for Investment Capital, Getting Your Ducks in a Row webinar. My name is Patrick Doherty from Lighter Capital, and today we're happy to introduce to you David Ehrenberg, founder and CEO of Early Growth Financial Services, and also Rob Belcher, Vice President here at Lighter Capital, to take you through the webinar. The guys are going to take us through some of the key points, and if you have any questions as they come up, just type them in to the panel there on the side of your webinar screen, and we will get to them as many as we can at the end of the webinar and see if we can get them answered for you. If we don't get them answered straight off today, we'll respond to you via email later on. So now I'm going to hand over to Rob to get things underway.
Thanks, Patrick. We're also going to record today's session, and so we'll post it up on our blog, and we'll also post up the full list of questions and answers if we don't get to everything, during the session today. Great. So thanks for joining us. We'll get started. Lighter Capital, we're based here in Seattle. We're a small team of technologists, former angels and VCs, and entrepreneurs ourselves. We've seen fundraising from both sides of the coin, and we think there's a better way. We employ a alternative investment structure called revenue-based finance that is non-dilutive to equity owners and also features flexible payments, so it does not have fixed payments like a mortgage or a car loan. And we also at the same time have technology that we use to speed up the underwriting process and also simplify the ongoing servicing process, so there's no mailing in checks or anything like that. So that's us in a nutshell. David?
Fantastic. Thank you very much, Rob. First of all, I wanted to say that I'm incredibly happy to be here. We've got great attendance for this event, and I wanted to thank Lighter Capital for inviting us to participate. And I think it's a great format, and hopefully it's going to be very useful for all of you. I am the CEO and founder of Early Growth Financial Services. We're a firm that does outsourced accounting and finance support for early stage companies. Our client base is all over the country. We currently work with around 200 active clients, and for those clients, we provide basic accounting services, we provide CFO services, and we do 409A valuations and taxes. Our whole value proposition is that we take all the back office from our clients and take care of it so that they can concentrate on building their products, providing services to their customers, creating partnerships, and worrying about the things that really matter for their business. And that's us.
Great, thanks. The high-level overview today is to get you thinking about your business and raising capital into the business, raising the right amount, the right kind, and really thinking about that whole process and going about it in the right manner. So we're going to talk about that first, getting you thinking about it, and then thinking about the actual game plan. And David's got some really interesting thoughts to share with you on how to approach fundraising. And then we're going to pull it all together in the form of sort of best practices for your pitch deck. And then lastly, we're very quickly going to cover due diligence documentation and all those sort of nuts and bolts things that you actually need to pull together to present for legal to actually do a financing. Great. Okay. So the first thing, I mean, this is all from our perspective. We have talked to hundreds and hundreds, and by we I mean David and I have talked to hundreds and hundreds of companies, and we ask these questions all the time. And so we wanted to share these questions with you so that you are aware of the things that we, as both your ambassador in David's case and your potential investor in our case, are thinking about. So financials, I think about financials in two ways. One is the actual performance, the historical performance, but then also the financial operating structure. What is the revenue model and what is the pricing model? When do you get paid by your customers? Do you not get paid for 90 days? Do you get paid by credit card immediately? These things all impact the financial operations of the business. And then, obviously.
Can I say, Rob, on the financials, one of the things that we often see with a lot of companies is that they've got a great concept or they've got a great idea or product that they want to develop, but they haven't thought through the monetization of that product. So it's very, very important that right from the very beginning, when companies are thinking about what they're going to do in terms of their business, that they have a very clear understanding of how they will monetize it, what the adoption rates will be, what the price will be, and how quickly they can grow their revenue. It needs to be a key concern right from the very beginning.
Great. And then, these are not in any kind of order. We think all of these things are important. So obviously the next category here is customers, and really thinking through who your target customer is. And then obviously presenting the existing customer base very clearly to potential investors, how many you have, what the value of a customer is, do you have a high attrition rate, renewal rate, and the acquisition cost of a customer. These are all very important things for software and technology companies, which is predominantly who both David and I work with. And then following on to that, sales, customer concentration and revenue growth, upselling potential, all of these things are important. Sales cycle, how long is your sales cycle? That really impacts your fundraising plans and your operating plan. And then lastly, if there's any gaps in your team, be honest about it. And potentially that's why you're raising money, so that you can hire staff. Anything else here, David?
No, I think that you just need to have a clear understanding of this. And when you go in to raise money, these are the types of things that you really need to think out in your own mind and have answers ready, because these are the kinds of questions that you're going to get from potential lenders, potential equity investors. So just making sure that you have a very good understanding of how all these things work and how you're pulling all these things together for your business.
I think that leads us really well into the next slide, which is thinking through how these things pull together into that fundraising plan, right? And so they impact how much money you need to raise and what it's going to be used for, if it is for hiring or maybe it's for marketing spend. And then, what type of financing and from whom is the right fit for your business. And then, is debt the right answer? Are you pre-revenue with an idea and you need, obviously the only type of financing that's going to be appropriate is equity financing. That's the only thing you have to sell is your own equity. And then, David, you've got some interesting points on this slide here.
The last bullet point on this slide says milestone financing. And one of the things that we like to talk a lot about is making sure that you have milestones in mind when you go out to raise money. And this is particularly important if you're going to raise equity money, because you want to be able to achieve certain deliverables, because the idea is that you want to have a higher valuation if you're doing an equity raise the next time you do a raise than you have this time. So you need to make sure that you accomplish certain specific tasks. And the reason you need a higher valuation is so that you have less dilution of your own equity structure. One of the things that we do quite a bit is we write a lot of blogs on different areas. And one of my favorite blogs that we've written recently is all about milestone financing. And it's probably worth reading. You can go to our site and you can check it out. But the important thing here is you want to make sure that you're raising money with a specific goal in mind. And that milestone can be a revenue milestone, it can be a product milestone, it can be a new market milestone, but you want to make sure that there's a specific purpose for the money, that you understand how much it will cost to get to that milestone, and to plan your raise all around that so that there are specific deliverables and that it's going to have a significant impact on your overall business.
Yeah, the more specific you can be about the need and the amount, the easier it is for an investor to understand the situation and get behind the plan. I think milestone financing is great. Even on the debt side, we often tranche our investments, and we'll do $250K today and $250K 6 months from now and increase our investment as you grow. And this is exactly what David is talking about is, we've seen the track record. You've deployed the capital. You've doubled your sales in 9 months, and so we can get excited about your next plan because you've achieved that milestone that you originally presented to us. I think it's a great way to approach. Yeah, approach financing.
Great way to approach it.
Okay, so very quickly, what are these options that are available? So this is a graphic that shows the sales or the business cycle, the life cycle of a startup, and the various options that are available. This is pretty focused on software and technology businesses, but it does apply to pretty much any industry. Obviously, when you've got just an idea, your own savings and your own, working for your own sweat equity is pretty much your only opportunity for capital. Maybe some friends and family, going to your parents. But once you get up and running and you have a real product and a real business, then you can start talking to angels and VCs. There are angels and VCs, obviously, that invest in pre-revenue businesses. And this is, like I said early on, this is one of the only, selling your equity is your only option really at this stage. I've got crowdfunding here in sort of shaded. It does actually, it's moving forward, and there are some advancements happening in the crowdfunding space. It's still, the kinks need to get worked out. And so it's shaded for now. But then
and in that area, Rob, can I chat a little bit about that? We've seen a lot of our clients get very excited about crowdfunding, and we've actually had a couple clients that have raised quite a bit of money on Kickstarter. So we have a company, Ouya, that just raised $11 million on Kickstarter. We have another company, Intello, that just raised some money on Kickstarter. And there's been some changes in the laws around crowdfunding. The new Jobs Act initiative that was just passed 3 weeks ago has really loosened the rules on crowdfunding, and a lot of our clients are starting to look at that as an option. I think that this is going to have a large impact on how money is raised, but as Rob has said, we haven't seen how that will roll out yet, but it's definitely something that if you guys are all looking to raise money and funds, it's something you should keep your eye on and think about.
Yeah, I totally agree. I think it's a very fascinating space and has the potential to completely democratize capital. So it is exciting. We'll have to see, a lot of regulatory uncertainty still, but it is exciting and interesting to look at. Continuing on this spectrum as a company grows, one that is really interesting, especially for subscription-based businesses and SaaS and software companies, is basically financing the company out of operations. My favorite anecdote here is this is how Amazon was built. They basically took your credit card, your payment through credit card for your book, and then they could pay their distributors on net 60 days. And so they were basically able to use customer and vendor financing to grow their company. They basically got terms and could grow their company without, well, they obviously raised lots of money, but this was a significant component to their growth, their rapid growth. I also want to talk about revenue-based financing.
One of the things on that, and I think we're going to talk about this at a little bit of a later date on the next slide, is that revenue-based financing and funding your growth through operations has the intrinsic value of allowing you to keep all the equity in your firm. So keeping ownership, which is incredibly, incredibly key. I know as a small business owner and as a founder of a company, that's incredibly important to me, and I'm sure it's incredibly important to everyone on this call. So that is the ideal type of financing if you can get it.
Yeah, that's a great point. There's an interesting gap here where early on your only option is to sell equity, and then later on you can actually have access to these strategic investors, that are industry investors or bank financing. But operations and structuring your operations correctly, and then revenue-based financing are one of the only things that's available in that very early stage as you're growing and gaining traction. So that's a great point, David. Thanks for that. And that leads into revenue-based financing. That's a structure that's technically a loan. It's free of dilution, or sometimes includes warrants or a small success fee, but it's usually pretty small compared to the size of investment. And then it's a loan that gets repaid out of revenue. So instead of a fixed monthly payment like your mortgage or a car loan, payments fluctuate up and down as sales, and actually more specifically than that, as cash fluctuates up and down. And then it's usually in the form of that Ladder Capital deploys it. It's usually a 3-year pseudo term loan that's used for growth initiatives. So it's an early stage growth loan. And then, as I mentioned, there's strategic investors and banks later on. Those are pretty common and are, like I said, for more established businesses usually. The running joke in the industry is banks only lend to people who don't need it. But it is a very low cost of capital, so once you can secure it, it's a great way to grow your business.
It's great.
Very quickly, wanted to run through the comparisons between bank financing, VC, and revenue-based financing. I think it's helpful to think about these things. Banks typically require personal guarantees, even on those really big investments. Say they do a $2 million term loan or a $1 million line of credit, they're still going to require a personal guarantee on that, either through all of management or even just the founder or the CEO. Revenue-based finance requires no, at least this is all from the structure that Lighter Capital deploys. There are other RBF providers out there that have different structures, so your experience may vary, but these are all based on our criteria. No personal guarantees. And then on the VC side, obviously no personal guarantee, but they do require board seats and protective provisions and can force you to basically sell the company when you don't want to, maybe before you see a good opportunity or something like that. Banks obviously offer no added value, but this is where VC really shines, and that's their huge offer is all the introductions you want, and then as well as lots of mentoring and education on growing a business and being a good entrepreneur and a good manager. Dilution, this is where bank debt is, sort of the best form of capital in the sense that there's no dilution, maybe sometimes warrants with venture debt or something like that. On the complete opposite side of the spectrum is VC, which is this is what the structure is, right? Is all equity ownership. And then, like I mentioned, revenue-based finance usually includes a small success fee or small warrants. Bank debt is the least flexible. VC is the most flexible. And revenue-based finance is an interesting hybrid where it's right in the middle, and it acts a little bit like equity in the sense that it fluctuates with the actual performance of the business. But we do get paid back monthly, like a bank loan. And then speed, Lighter Capital is meant to be lighter, so we really focus on being fast, and most of the other sources of capital take quite a while to raise. David, I don't know, do you have much experience with that? Are these times for bank debt and VC accurate, or have you seen faster or slower?
No, I think these are good. I think these are good placeholders. We typically see our companies, when they're raising equity funds, they typically take about 3 to 6 months. The expectation that we set with any company that is doing a raise is that if they want to go after VC money, to plan for 6 months. It's a long, lengthy process. It's a business development process. There's a lot of meetings that it entails. Typically, if you're going to get VC funding, you're going to have at least 5 or 6 meetings with the venture capitalists. They're going to do deep due diligence, and there is typically at least a 30-day period of time between the initial term sheet and the closing of the deal. So if you do want to raise venture capital money, you do need to make sure that you give yourself quite a bit of time and understand that it's a lengthy process. A lot of times our CEOs for our early stage companies spend at least 50% of their time raising money. And that's difficult. That's a huge, huge time sink for an early stage entrepreneur who's also concentrating on starting their business and getting it out of the box. I think it's also worth noting that a lot of times early stage companies, especially technology companies, they think about venture capital, and they think about venture capital as the only route that they can go. But it's important to remember that 99.9999% of companies are started without any equity investments. And venture capital, although they bring a lot of value in terms of partnerships and introductions, it's really not the most ideal form of financing your company because you're giving up huge dilution, you're giving up ownership, and that ownership is very real. You're bringing in people who are going to have very strong opinions on how you should run your business, who your executive team should be, what you should look like, and probably most important, all VCs are looking for a quick exit. So their incentives and their goals could be very different from your incentives and your goals, and they're not always aligned. Venture capital is important for our ecosystem and for what we do, but if you can create a company and start a company without venture capital and use either revenue-based financing or bank debt, that's absolutely preferable in almost every situation.
That's great, David. You mentioned so many good points. I've got a great story that I want to hit. I know you've got more that you're going to talk about on the business development side of fundraising. I've got a great story I want to share. And then the thing I will say is, like I said, we really focus on being lightweight and fast. Like we use technology to speed up the underwriting process. And when we really want to get the CEO, who's oftentimes the core, either the core technologist or the core salesperson, off that fundraising path that you were just talking about, David, and get them back into building the business. And so that's our goal. And I know back to those questions we were asking earlier on about where and how to raise money, people like David, who have done this for hundreds of companies, can also help, because he's obviously got all these connections. He's already done it for all these other companies, and he's got a Rolodex full of VCs to go talk to, or bankers at Silicon Valley Bank or Square One or whatever. And so I would say that that's also another way to speed up that process and relax some of that time commitment on fundraising. Okay, so moving forward, we've kind of covered it. I think you get it. This is just one last time. This is how revenue-based finance basically works. As your revenues go up and down, your payment is based on a fixed % of your revenue until the loan is completely paid off. And so we're going to switch gears and talk about more of actually pulling together your business plan and the pitch and all of the pieces that go into raising money and presenting the company towards investors.
So we obviously help a lot of our clients as they're raising money and as they're pulling together everything to go out and do that raise. And one of the advantages of that is that it's become very standardized in terms of expectations of what potential lenders and potential equity investors want to see. Early stage companies have been raising money now for a long time, and the people that are providing the cash and the debt and the equity investments have certain things that they always want to see, and it's become very, very standardized. There's a couple different resources that I always suggest entrepreneurs to look at that will provide some insight into what this package of information looks like. The first resource is a book by Guy Kawasaki, and Guy Kawasaki is one of the early venture capitalists and one of the big name venture capitalists. He started Garage Ventures. He was an early spokesperson and thought leader for Google, and he's a major venture capitalist in the Silicon Valley. And he's written a book called The Art of Start that talks about all the different information that you need to go out and raise money. And he talks about what that information should look like, what the process looks like, and how to do business development for it. Another book that's in a similar vein is by Mark Phillips. And Mark is a venture capitalist and a general partner for Arafora Ventures. And he has written a book called The Insider's Guide to Silicon Valley, How the Deal Gets Done. And both Guy Kawasaki's book and Mark Phillips' books talks about what type of an executive summary you need to pull together. And it's typically a 1 or 2 page executive summary that gives a brief overview of the company, of the management team, of what you're doing, and what your financial projections are. In addition to that, you will need a pitch deck. And the pitch deck is typically 10 to 12 slides, and those slides cover very specific areas. And there's a very specific sequence that venture capitalists and debt providers like to see that information presented in. And part of that includes a product demonstration and also a financial model that gives both your revenue projections and the overall market size. But you need to make sure that you have this package together. In a very similar way that you're going to be doing a sales pitch to a potential customer, you need to pull together certain information and you need to have a narrative and a story. When you go out to raise money, you need to have a strong executive summary, you need to have a strong pitch deck, you need to understand your financial model, and you need to have practice telling your story. Want to jump to the next slide?
Yeah. That's good.
The key slides in your pitch deck are going to be all about who you are as a company, what the problem is that you're solving, what your overall market opportunity is, how large is the market, who is in the market, what the revenue potential is going to be, who you're going to focus on first, what your market strategy is, how you're going to attack this market. How are you actually going to bring in revenue? How are you going to actually complete sales? Who are your target initial customers going to be? The competitive landscape, Who else is in your space? What are they doing? How are you different? What is your technology? What is the innovation in your technology? How is your technology different from what people are currently doing? What is the price of your technology? How are you going to manufacture or produce your product? What is that going to look like? If it's a hardware product, who's going to build it? Where are you going to build it? If it's services, where are you going to get your people? What are those people going to look like? Who your management team is. And this is probably the most important piece. Over and over again, when we're talking to venture capitalists, and we're talking to debt providers, and we're talking to people like lender capital, the refrain that we hear over and over again is, we are looking for great teams. And a great team can be a lot of different things. It can be a successful entrepreneur that's done this before. This can be someone who has subject matter expertise in an area. It can be someone that's been in a large corporation but has quite a bit of experience in these different areas. Or it can be someone who has a clear vision, a drive, and a charisma, even if they haven't succeeded before. We have a lot of clients that this is their first time out of the box, but they have a drive, they have a vision, they have charisma, they have all the things that investors look for in a management team. And then obviously, it's important to have your financial model together. And this is an area where we help a lot of our clients. We'll talk a little bit more about what's necessary for your financials. And then the last piece is, how much money are you looking for? And once again, this should be tied into milestone financing. So if we raise this money now, this is how we're going to utilize that money. This is what we're going to do with it. And as part of that funding requirement, you should not only identify what you're raising now, but what you're going to need to raise in the future. I think we're done with this slide.
Okay.
In terms of pulling together your financial projections, there's really two different types of financial models that you need. The first one is a top-down projection. And what a top-down projection is it's an identification of what the market is and what the total market size is. So if I'm creating a technology that has to do with a new form of radiology and a new way of taking x-rays, I may know that the overall radiology market today is worth $4 billion annually. And if we're specifically focusing on CAT scans within the overall radiology market, we may know that that's worth $750 million. That's what the top-down projection is. It's saying, hey, this is the overall market size and the overall market opportunity. And investors like to know this because oftentimes an investor, especially a venture capitalist, wants to ensure that it's a large market, that there's the opportunity for large returns. But even a lender or a revenue-based financing person is going to be looking for the overall opportunity because they want to make sure that there is a real business here and that there's something that can grow. So the top-down projection, although it's a little soft, is a very important area to identify and to understand. A bottoms-up projection is a more traditional financial model. And that really is, what's your revenue going to look like in year one? What's it going to look like in year two? What's it going to look like in year three? How are you going to grow that revenue? What are the variables that go into that revenue? How many customers do you anticipate having? What type of cash are they going to bring into the business? What is the spend that you need to support your revenue? How many people do you need to hire? How quickly are you planning on hiring people? What contractors and professional services do you need? Do you need to purchase fixed assets? What will your legal fees be? What will your accounting fees be? How much are you going to spend on taxes? A bottoms-up forecast is really your baseline budget, but it's incredibly, incredibly important that you understand the variables, the different scenarios for your budget, and how your budget's going to play out. Because ultimately, they're going to be giving you money to support your budget, and they're going to be watching it very closely to make sure that you're executing against the budget that you presented.
Yeah, I think that's a good point in that, you know, a VC and even us, you know, we want to be sold on the dream, the top-down projection. What is the total market out there? But at the end of the day, all of these things, including a VC, it's still a financial transaction. They're giving you financing, and so they need the bottoms-up projection at the same time to fully understand where the financing is going and how it's being spent and what it's going to get and where it's going to put the company on the back end of the investment. So both of these are really critical, and you know, the dream and the big picture and revolutionizing an industry is wonderful, and you know, I think all investors want to hear that, but they also really need this sort of level of detail too.
And can I say, Rob, that the two books that I mentioned earlier, both Guy Kawasaki's book and Mark Phillips' book, talks about all the different slides that you need for your pitch deck, and it also talks about what a top-down projection looks like and what a bottom-up projection looks like. So you know, these are good resources. We also have quite a bit of information on our website about what these should look like and how you should go about preparing them.
Hey, David, we got a question that's pretty interesting that I think you'll have good insight into. The question is, how far should you take your projections out?
Yeah, so the standard used to be 5 years. And I think that standard has really changed because I think most VCs have realized that especially at the earlier stages, it's hard enough to project out 6 to 12 months without being able to go out to 5 years. So what we are typically seeing is we're seeing a 3-year projection. And in the first year, we're seeing those projections done on a quarterly basis. So 4 quarters for the first year, and then a projection for year 2 and a projection for year 3. I think that most venture capitalists and most lenders and most revenue-based lenders all understand that business plans are going to change and that it's important that people are flexible and have the ability to change once they've raised money. But you should at least have a good sense of where you want to go when you raise the money for the next 2 or 3 years, and you should be able to talk about it in a detailed way.
I would completely echo that. We structure all our financing to have a life of about 3 years. If things go swimmingly, you might pay us back a little faster than that. If things go poorly, you might pay us back over a longer period of time. But from what we've seen, you're exactly right, and I would totally agree that 2 to 3 years is 3 to 4 years, 4 to 5 years is a lifetime for a small early stage company with 6 to 12 months of a track record. And so, forecasting 2 years you can kind of do, 3 years gets a little foggy, and then 4 to 5 years is anyone's guess.
And this doesn't mean that your forecast isn't going to change over time, but the ability to plan and to have a strategic vision and to execute against it is very, very important. And a clear understanding of how you're going to utilize the investment capital that you bring in is very, very important. So even if you are changing your business plan or pivoting a bit during the course of your business, you want to make sure that every time you do that, financial modeling and financial planning goes into that. And it's also very important that once you've raised money, if you do change your business plan or if you do pivot, you want to make sure that your lenders and your equity investors are aware of it and that it's a dialogue.
Yeah, that's great. I appreciate you putting the vote in for that. It's really important that we are on board. We often support any type of pivot or change of direction as long as just we get the heads up, and it's possible we could even help you, and help direct you or make an introduction or a BD introduction or something like that to help you on your new path. So that is critical.
Part of that is you want to make sure that you get that help from folks like Lighter Capital or from VCs, but also you want to make sure that you keep the door open for a future raise. And so the more you treat your investors like partners and the more you have a true partnership, the better off you're going to be in the long term.
That's true. It is a partnership, and that goes back to the choosing the right form of capital early on, because it is a 2 to 3 year commitment, or longer if it's equity. I mean, if it's equity, I've heard the term that your cap table is only clean once. If you take equity investment, they're part of your cap table forever. So you want to make sure the partnership is right from the get-go.
No, and that's incredibly, incredibly important. So if you think back to the slide that Rob presented on the different types of equity investors, there's obviously different equity investors and debt investors that you want to bring in at different stages, and different folks that are appropriate for different stages. But it's not just going to be about bringing in the cash, especially when you're talking about venture capitalists. There are people that are going to be sitting on your board. But even if you're talking about revenue-based investors or bank providers, these are people that are going to have material and legal rights in your company. And it's very important that you like these people and that you want to work with these people. If things are going swimmingly and the company's doing great, it becomes a little less important, but a lot of times there's hiccups along the road. A lot of times there's roadblocks. A lot of times there's problems, and you want to make sure that your debt and equity investors are people that you want to work with when things get tough. When things get hard, you want to make sure that you've got good people at the table. And good people are people that have been through this before. They're people that have integrity in how they're going to treat your business and how they're going to treat you. And they're people that are going to be able to provide value when things go badly.
And I mean, I think another point on this is, we've worked with, I think that's all great, David, and we've worked with a variety of experienced entrepreneurs and first timers. And when things do get a little stressful, we've found that it's really helpful when the entrepreneur has help outside from their investors as well, leaning on a good lawyer or a good outsourced firm like David, who's gone through this hundreds of times and has seen almost every scenario. I strongly recommend those type of relationships also to be brought in, because that can be, that can save everyone a lot of headache when you bring in a professional who can help guide you through a transaction or an event or something, unfortunately in a down case, or even in an upside case. Even if you're looking at an acquisition, bring some help in if you're unsure of what you're looking at. We've looked over VC term sheets for some of our companies as they've looked to possibly take on a big equity raise and help them. This is a terrible deal. This is a great deal. You should totally take advantage of this. And so do lean on your lawyers and your CFO group if you are unsure of anything. I think we've covered the slide pretty thoroughly. Should we move on?
So the fundraising process is like any other business development process that you're going to go into. It's a sales process. So what you need to do is think about your plan for how you want to raise money. So sit down and say, how much money do I need to raise? What milestones am I going to raise with it? What kind of money can I raise? So do I have revenue yet, which would open up the door to revenue-based financing? Do I need to purchase capital equipment? In which case you open up the door to equipment-based financing with banks. Am I at an early stage where I need to raise a small amount of money, which means that I'm probably appropriate for friends and family or for angels? Am I a little bit larger stage, but pre-revenue, which means I might be open for super angel investors and seed venture capitalists? Where do I need to raise the money for? What is a good fit for us? And then going out and looking at the marketplace. Who are the investors that are investing in this space? What stage are they investing in? What sectors are they investing in? Are they only technology investors? Are they hardware investors? Are they software investors? Are they traditional retail investors? Who is in the market for my sector? Do the different investors have a geographic focus? Are they investing nationwide, or are they just investing in California or in Washington or in Seattle? Understanding all those different things so that you can identify who your targets are and who you want to go after. And then pulling together all of your information that we talked about before, the pitch deck, the executive summary, the financial model, all the supporting information that you need around this raise. And then it's identifying how are you going to reach out to these people. I am a big believer of making sure that you have great strategic partners right from the very beginning. And those strategic partners come in a couple of different ways. The first way that they come in is your board advisors, the people that are on your management team, the people that are sitting on your kitchen council, the folks that you rely on, make sure that you have people that are plugged in to different folks that are in the fundraising arena, different venture capitalists, different debt providers, different revenue-based lenders, things like that. So making sure that your board members and your management team can all have ties into this community. Also think about the professional service providers that you brought on board. So a lot of lawyers can incorporate your company. A lot of lawyers can help you with your early stage documentation. But finding lawyers that also have ties into the venture community, that have ties into the lender community, that know folks that you can raise money from. You're going to be paying lawyers a lot of money in any scenario. So make sure that the lawyers that you have ancillary value that they can provide. In the same way that you're looking at your lawyers, look at your bank. Not all banks are created equal. Most banks have the same terms. Most banks have the same interest rates. Most banks have the same services. But a lot of banks provide ancillary value. If you're a technology bank, look at a technology, if you're a technology company, look at a technology bank like Silicon Valley Bank or Square One Bank or Comerica. If you're a retail bank, look for a bank that has a really strong practice in the retail space and where you can have a banker who knows that space well. In the same way that you're looking at your bank and your lawyer, look at your accounting firm. Look at your other professional service providers. Look at your benefit broker. You want to make sure that all the folks that you're working with can not just provide their service, but can also provide you with ancillary value. So you identify who you're targeting, you pull together all of your information, and then you go through the business development process of saying who on my team, either the management team, my board, or my professional service providers can introduce me to these people. How do I reach all these different folks? How do I make sure that I'm being introduced to the right folks, referred to the right folks, and that I have people who can help me through this process? But you really need to think about this. This is a strategic plan that you need to pull together to raise funds. And you don't want to do it haphazardly. You want to sit down and you actually want to think it through.
David, that's great. I want to jump in with 2 points. One is banking. I think that's really overlooked, and I'm really glad you brought that up. When you first start up, you kind of think about who's got the best deal for me, right? And oftentimes it's a small community bank or a credit union or something like that. And so we talk to a lot of companies who are banking with small credit unions and a community bank, and that's fine. I will say that if you start to think about institutional money, especially on the lending side, it actually is really important that you work with a bank that is full service and has a lot of the infrastructure built that can support a big operation and a big company that might have international sales, international ACH, international wire transfers, and all kinds of things. We use some technology to speed up all of the processes that we use to underwrite loans and monitor them. And if you're not with a real bank, it makes these kind of the efficient fundraising process really difficult. So something to think about there. And then your comment about the fundraising process as a sales process, I love that. I think it's pretty interesting. I recently heard, it's a little bit different. I recently heard a hedge fund manager, so he's still raising money, right? He needs to raise money to then go invest in his hedge fund. So he's still got to go raise money. I heard him, so it's a little bit different, but it's related. He was talking about raising a fund. He was starting out on his own and wanted to raise a fund. And he started with 300 contacts. Right away, he only received 50%, I think 150 of those actually called him back. He got an actual meeting with, I think, 20 of them. He had a second meeting with 5 and ended up closing with 2. And so I thought that was a really interesting pipeline of basically approaching the sales process of fundraising. And I think that speaks to what you were just talking about.
No, I think that's a great point, Rob, because it's like any other sales process or any other business development process. And you should just think about it that way.
Yeah. Good. So now we're going to dive into, we'll just quickly go through this stuff. We'll post all this. It'll be on the blog. It'll be recorded. We'll post the list up. This is all the due diligence requirements and things that you need to make sure. Some of this stuff won't apply to every company. but a lot of it will, and it's pretty much required for any type of institutional raise. You've got to have all this legal documentation right. You know, your incorporation on a napkin certainly won't fly in a court of law. So we'll go through this pretty quickly, and then we've got some good questions, and then we'll let you go about your day.
And can I just say on this, Rob, I mean, the important thing, this is a laundry list of stuff that you're going to need. And this stuff really comes into play once you get into the due diligence process. So the way that this will work is you're going to pull together all of your information. You're going to pull together everything that you need to present to potential investors. You're going to identify those potential investors. You're going to set up a bunch of meetings, and then you're going to start having conversations. And you'll typically have several different conversations with your potential investors. And if they like your business idea, if they like what you're doing, they will go into a formal due diligence process. And that's when all this information becomes very material. And a lot of it's just checking the box. Do you have this done correctly? Do you have your information pulled together? And a lot of it is just good housekeeping. So a lot of this is just as simple as making sure that you have a good system for filing all of your different important corporate information, and do you have that readily available to potential investors when you get ready. And a lot of times we see folks, they open up a Google Docs or a Box.net or a Box account, and they pull together all this different due diligence information, and they have it there so that when due diligence starts, it's very, very easy to just hand it off. This shouldn't be an area where there's a lot of strategic thought involved, but it's just all about getting, as the seminar is called, getting all of your ducks in a row and getting everything pulled together so that when the due diligence process starts, there's no hiccups and everything's there and easy to get to the investors, and it's pretty straightforward.
Yeah, and especially, you know, this is important for equity investors. It's especially important for debt investors where there's security interests involved and there might be subordination documents involved. And so, you know, having all of your intellectual property documented correctly and everything and being able to present it quickly and efficiently is the name of the game. So let's dive in and just quickly go through it. Like David said, there's no strategy here. It's just these are the things to keep in mind and know where they are and be able to have them at the ready.
Rob, did you want me to read through this, or?
I don't know if we need to read through it. I think we'll, you know, just spend a minute here. These are all of the corporate records, depending on what your structure is. If you're an LLC, a C corp, something that's interesting. We can invest in any type of structure in U.S. and Canada. Most equity investors, you know, at the angel stage, when you're doing an angel round, you can do convertible debt and things into LLCs or S corps. But formal VCs will ask you to convert into a C corp and issue formal stock. That's something to keep in mind too, that you will likely be converting into a C corp and having a certificate of incorporation. But,
yeah, no, and I think that's, Rob, can I say just on that very quickly? I think that is a key differentiator between getting equity investments and getting some other form of capital. A lot of times it makes sense to set your company up as a sole proprietorship or as an S corp or an limited liability partnership or a limited liability corporation. And there's a lot of great reasons to set your company up in any of those formats. And there's nothing wrong with it. And it often makes the most sense for the entrepreneur and the founder. But if you are going to go out for venture capital or equity investments, you do have to become a C corp. And typically, a lot of the investors we work with not only want you to be a C corp, but they want you to be a Delaware C corp. It's not a bad thing, but it is a limitation of getting equity investments, and it's one of the ways that the other forms of investment dollars become superior.
Yeah, that's great. Like I said, we have done some, we initially were only doing C corps as well, but we've worked with our lawyers to open that flexibility towards our goal of providing more capital to more companies in a more flexible manner. So we won't go through this, but these are all of those documents that you might need to have at the ready. And then security issuances is particularly important for debt from our perspective. Like I said, we usually are first, we're senior secured. If you have a bank line of credit or even a term loan, we will subordinate to that. But you certainly need to have all of those documents on hand. And there will probably be some sort of intercreditor agreements or subordination agreements or things as well. Any points here, David?
No.
This is also important on the debt side particularly, and I think probably on the equity side as well. I mean, any type of judgment against the company, but I mean, if you have a tax lien or something against the company, the IRS is absolutely first. They come before a bank and especially before us, and definitely before equity. So having all of these agreements or any type of, if there's any kind of workout of any existing loan or something like that, very important. Banks and SBA lenders will certainly look at personal credit scores. We do not. We don't care if you've had a bankruptcy or if you have low personal credit. And again, we don't take a personal guarantee, so we don't even look at that stuff. But
we've had commercial banks that have actually rejected clients that were C Corps because of personal credit scores. So that is an important point. The other thing that's worth mentioning on this slide is that a lot of times our clients don't have their employee records in order when they go out to raise money. And you want to make sure that for every employee you have an agreement with that employee, you have an offer letter, you have a non-disclosure agreement with that employee, and you have a stock option agreement with that employee. So it's very, very important to make sure that all of your administrative filings are in order around your employees, because for whatever reason, we typically see a lot of hiccups in that area.
Yeah, and we do too. I think that's a good one. You know, especially if you're talking about a team of 5 and maybe there's 3 founders. Something that's really interesting that comes up a lot for us is founder salary, founder pay, and then also any founder loans. So oftentimes the management and the founding team, I mean, it's small, it's early, they're just kind of going, they're not really thinking about this stuff, and they just pay themselves whatever's left in the kitty at the end of the month. Well, if you end up going and raising institutional capital, that doesn't fly, right? We need to actually know, you know, because we're first in line to any money in case of a downside. And so if you're just going to pay yourself out if you know that the company is about to crater, that certainly isn't a tenable solution for us. So we need to actually see documented salary information for management. And then if there's any founder loans, I mean, oftentimes founders are just kind of, you know, feeding money in from their savings into the company on cash flow low months, and then they'll just pay themselves back whenever there's free cash. And that's great when it's just you, but when you raise institutional money, whether it's debt or equity, those kind of things need to be locked down and solidified and really clearly. This goes back to the communication point that David made earlier between your investor. You know, communicating those things clearly. And we usually, you know, we make it very easy for you to work that out and get paid back. We just need to know what the schedule is going to be and know that there is a schedule and you're not just kind of at will taking money in and out of the company.
Clear communication.
Yeah, I think it's really good. This one's important for us as well, mostly because we are a senior secured lender, and oftentimes we're investing in companies with no hard assets, and so oftentimes the IP is the asset. So having any IP documents, and we also ask for domain name assignments. Oftentimes the product really is the domain name or the service, and those are only obviously in a downside scenario. We're not meant to take control of the company or anything, but just having these things, you know, all your ducks in a row regarding this stuff is really important as well.
And the downside scenario is really the key phrase around intellectual property. This becomes a huge issue when things go badly. So it's important that it's identified right from the beginning and having a clear understanding of who owns what. We've seen a lot of issues around this. Yeah,
that's a good point. We, you know, luckily we haven't had too many issues in the downside scenario, but you know, we're only owed what we're owed, and so we will, you know, do everything we can to recoup what we're owed. But after that, if we sell your IP for $5 million and you only owe us $200,000, away you go. You know, if the company kind of isn't moving forward and it's stalling, and you sell off whatever you have, you know, that still goes to the equity holders. But you need to know who owns it and what the order is of that waterfall. That's critical.
And about 1/3 of our clients fail, and in almost every situation where we have a company that fails, we have several discussions about who owns the intellectual property and what happens with it.
Interesting. That's good. Yeah, not to bring the webinar down to a bummer of an ending. But
my last comment for the webinar. Well, we've got
yeah,
questions, right?
yeah, it's important. It's really important, and I think that goes to this whole content. Is all of this content, this whole webinar, is basically to structure everything correctly, and so that if there is any issues, it all gets worked out really painlessly, and there's no ambiguity. That's the point of what we're talking about here. So yeah, it is an important piece. And then yeah, here we are, right? The litigation and the disputes piece. But I think mostly the comment here is to make sure any existing litigation or disputes are clearly communicated and documented.
There just should be no surprises once someone lends you money. So there shouldn't be any conversations about, well, why didn't you tell me this, or why didn't you know about that? If you just want to disclose everything, be honest and truthful in your communications, let everyone know everything that's going on, and then find the right investor for you.
And a laundry list of some extra things. This is, yeah, obviously bank accounts. Any lender's going to ask for bank statements or ask you to be a borrower at their bank, or a depositor at their bank. And then just all of these other documents. We'll post all this up. David, if you have any specific things you want to talk about here, but this is sort of the sundry.
No, I think this is a really good list. So we have a Word document that we give to our clients when they're getting ready to do a raise of all the due diligence items that they need to pull together. And everything that we've identified on these slides is on that Word document. And it's just really good housekeeping, making sure that you have all the information available.
Yeah, and some of these things are very positive, right? They're not to show anything negative. If you've got a permit to work with the government or some sort of clearance or POs with big customers, that's all great stuff.
Right. No, absolutely. Or management information, memorandum of understanding, or things like that. Yeah. Absolutely, Rob. I echo that. Yep. Should we jump into questions, Rob? Because I think we're running low on time.
Yeah, absolutely. I think we've got a couple good ones, so let's do it.
Okay, so Rob, maybe we'll start with you. You've got some questions around revenue-based financing specifically.
Sure.
The first one is, could you just go through a quick example of paying back a loan? How long does it take? And is the term length fixed, or does it depend on some other variables? And what happens if you can't pay it back?
Yeah, good. Okay, I'll quickly, so we have a whole webinar on just revenue-based finance, and then a fair amount of content. I mean, obviously this is what we do, right? We educate people about revenue-based finance because it's a new alternative. It's been around for a long time. Royalty finance has been around for a long, long time to finance oil wells and gold mines and movies and books, but we're deploying it to small early-stage software companies, and it's been a great success so far. And it's, as David said, finding the right partner. So, with the 23 odd companies we've worked with, it's been a really good partnership so far. We invest $50K to $1 million in exchange for usually a single-digit % of revenue. So something like, call it 6. So maybe we do a $200,000 loan for 6% of the company's cash flow each month, and that goes on until we've received 2x our investment. So we're looking for $400K total. That includes the $200K in principal. We usually target, like I said, anywhere from a 3 to 5 year repayment window, which works out to a 15 to 30% roughly equivalent interest rate. You think of, we're asking for quote unquote 100% worth of interest, but over 4 years is 25% per year. And that's our target cost of capital. It's depending on your growth and everything, 15 to 30%. It's more expensive than a bank, but it's really in line with a credit card, and it's a whole lot more capital than you can get from a credit card. We do only work with companies that have established revenue, and we only can lend up to about a third of a company's run rate. So if you're $1 million company, we can do about $300K, and that's what keeps the royalty rate down. Obviously, if you're $1 million company and we gave you $1 million, we'd have to ask for 50% of your cash flow just to get paid back our principal in 2 years. And so that's untenable for everybody. So we lend up to about a third, and that's usually anywhere from 2 to 10% of revenue each month. And that goes until it's till 2x, and then, like I said, usually like a 1 or 2% success fee in the case that the company is acquired. I don't want to take up too much more time on that. I know it's really, there's a lot of questions. I'd love to talk to you independently if you want to talk more scenarios about your individual scenario. But I know, like I said, there's tons of content on our website about it. and want to leave questions for other things. Leave time for other questions.
Sure. Just one more, just on revenue-based financing. Does debt or revenue-based financing impact on any subsequent equity-based financing round?
That's a great question. We do have companies that we have invested in that have subsequently gone on and raised equity, and a couple things can happen depending on where we are in our investment. Your payback, if it's 3 months after you did your investment, that full 2x is hanging out there, and most equity investors won't want to see that much capital, or it depends on what the size of the raise is, but they don't want to see capital at all going outside the business. They want to see it going towards growth. And so they may ask for the debt to just stay in. If you're pretty close to paying off the loan, or you're halfway or 3/4 of the way towards paying it off, oftentimes we'll get paid out when that happens, because equity investors don't actually want any debt in the cap table. And then, like I said, it's kind of a mix. We've seen both, but we play very nicely. And like I said, this is where having somebody on your side to explain all the options and talk things through is really helpful, because they've seen the scenario many more times than you have. So it's really, really valuable to have somebody help walk you through these transactions.
Okay, thanks. David, these couple might be for you, and it's sort of around projections and business plans. First is, are VCs looking for market data from industry firms like Gartner, IDC, Frost & Sullivan, or are there other reliable and cost-effective resources?
So when you're pulling together your top-down projection, the overall market size, I think it's very useful to use information from these different types of firms like Gartner that do market sizing information and research different markets. But we are seeing more and more of our clients also just pull information from Google and from the web. I think it's important to be able to document the size of the markets and what the different segments of a market look like. And I think it's important to have a credible source for that. But I think you can pull this information from a lot of different places. And oftentimes there's enough information available that you don't actually have to pay a firm like Gartner to produce that kind of information.
And another one, once you begin to value a company, what is the best source to identify what is the right valuation multiple, e.g. sales, EBITDA, etc.?
Yeah, that's a hard question because there's not a hard and fast answer to it. Part of it depends on how hot the space is. Part of it depends on who you are and what your track record is. Part of it depends on what the revenue opportunity is. But the best way to determine your valuation is to look at what other similar companies to you are getting valued at and what their valuation multiple is and what types of offers that you've gotten. You want to run this like a business development process. The more offers you have, the more different players that you have that are interested in your business and interested in investing in your business, the higher your multiple is going to be, and the more room for negotiation you can have. But unfortunately, there's not a hard and fast rule on this.
Yeah, I think that's great. I think I was just reading over the questions. I think that's probably it for questions we'll cover now. We'll let everyone get going. I think we're pretty much out of time. We've got a couple more that we can quickly type up and we'll post on our blog and share with David to post on his blog. And I think that's about it. David, unless you had any other final comments, we'll probably let everyone get going.
The one comment I wanted to make was, thank you to Lighter Capital and Rob for inviting us to do this. I think that this has been great, and we really, really appreciate the invitation. And then thank you to everyone that attended the call. We had 75, 80 attendees on this call, and I know you are all very, very busy entrepreneurs, and you have a lot of things going on. So we appreciate you giving us an hour of your time, and I hope it was worthwhile.
I echo all of that. Thank you, David, for your insight. You've worked with many, many, many more companies than we have, and this has been really good. And like I said, we'll post all this and share it with you. We'll send out an email when it's all posted so everyone knows where and how to find it. And if you have any other questions, feel free to reach out to David or I, and we look forward to working with you guys, and best of luck to you.
Thank you.
Thanks.
All right. Thanks, guys.